The Indian share market is buzzing. 2024 was a good year. The Sensex and Nifty 50 saw double-digit growth. This was driven by strong domestic companies. They invested heavily in growth. Telecom, healthcare, technology, and consumer discretionary sectors were top performers. India stood out among its Asian peers. However, no market goes up forever. The Indian market is currently considered expensive. This is compared to its history and other Asian markets. This means there is a risk of prices falling. We call this a correction. In fact, the market experienced a correction in late 2024. Despite this, India's overall economic picture is positive. Strong fundamentals support future growth. Foreign investors are showing interest. Domestic spending is also robust. This makes the Indian market attractive for long-term investors. But remember, investing always has risks. It's important to stay informed and make smart decisions. The 2025-26 budget brought mixed reactions from the market. Some sectors celebrated, others faced uncertainty. The FMCG, realty, media, and auto sectors rejoiced. The budget brought good news for them. However, PSU banks, metals, pharma, and oil and gas weren't as lucky. The budget impacted them negatively. Key announcements included income tax relief and reduced capital expenditure targets. These changes aim to boost growth and attract foreign investment. Specific sectors saw a mixed bag. Insurance, footwear, agriculture, and EV battery manufacturing were favored. Banking had mixed reactions. Defense and railway stocks faced headwinds. The budget's impact is still unfolding. It's crucial to watch how these sectors adapt in the coming months. The US market holds significant sway over global markets. Its performance can make or break others. This is because it represents a large portion of the global stock market. The Economic Survey 2025 flags a concern. US market valuations are high. This could lead to a correction. What happens in the US doesn't stay in the US. A US market correction could easily spill over to India. This is where retail investors need to be careful. The pandemic brought a surge of new, young investors to the Indian market. Many are new to market volatility. These investors might react emotionally to a downturn. Panic selling could amplify losses. While the direct influence of the US market on India seems lower now, historical data paints a different picture. When the US market sneezes, India often catches a cold. Foreign investors love the Indian growth story. They have been pouring money into the market. This has been a key driver of the market's rise. But here's the catch. They are also quick to pull out if things get shaky. Valuations are a concern. Some sectors like technology and healthcare are looking expensive. This increases the risk of a correction. On the other hand, financials and energy seem reasonably valued. Despite the risks, India's long-term growth prospects are bright. Sectors like technology, consumer discretionary, and healthcare are leading the charge. Strong domestic consumption and a growing middle class are driving demand. However, remember, investing is a marathon, not a sprint. Stay focused on your goals. Don't let short-term market swings derail your long-term financial plan.